under the shadow of the factories and the power plants that once made Europe hum. A quiet emergency has been unfolding. Germany, the continent's economic engine, is shrinking for years. Factories are idling, and political leaders have torn up the rulebook they built after the last crisis. Berlin has chosen a single colossal gamble, hundreds of billions of euros in public investment to sprint an industrial economy back to life. What happens next will decide more than Germany's future. It could remake Europe's economic order. This is the story of that bet, how it was made, and why the stakes could not be higher. For generations, Germany's economy was the model of restraint. It exported more than most countries could imagine, built an industrial backbone of cars, chemicals, and machines, and translated those exports into steady surpluses that masked deeper structural risks. The country's fiscal rules, the so-called debt brake, were not only law, they were a creed. But when supply chains snapped during the pandemic, and then energy prices exploded after the war in Ukraine, the very strengths that had kept Germany secure suddenly became vulnerabilities. Factories that relied on cheap energy could not run. Exports that once paid the bills faced falling demand. The political answer, finally, was dramatic. A state-led investment program so large it rewrites decades of fiscal orthodoxy. This is not a small stimulus. In the spring of 2025, Berlin authorized a spending package, roughly €500 billion, that would ram through infrastructure, energy transition, and industrial upgrades. For a country built on balanced books, this is a seismic shift. The debt brake that once limited borrowing has been bent to allow extraordinary investment. The plan is blunt and simple in its logic. Spend now to fix bottlenecks and energy insecurity. Boost productivity, create jobs, and then let higher growth make the books palatable again. But simple does not mean safe. The cost of delay, corruption, political pushback, or global market shocks could turn a rescue into a long, costly drag on public finances. To understand the urgency, look at the energy shock. Before Russia's full-scale invasion of Ukraine, Germany imported a large share of its natural gas from Russia, a dependence that left factories and power stations vulnerable when supplies and prices swung wildly. The spike in energy costs was not abstract. It forced smelters, chemical plants, and other energy-intensive businesses to slow or suspend operations. For an economy where manufacturing and exports remain unusually large compared with many peers, that is existential. The result was a sudden and deep hit to output, investment, and confidence. There is a second structural problem. Germany's model depends on selling things abroad. Exports have long formed a much bigger slice of Germany's GDP than in other large advanced economies. That export reliance magnifies downturns. When foreign demand stumbles, the whole machine loses torque. In a crisis where demand, energy costs, and logistics all move against exporters, the usual private sector-led fixes are too slow, and that has pushed policymakers toward a more muscular state. Financial markets reacted fast. Bond yields on German long-term debt have risen as investors ask how the sovereign will fund this unprecedented package and whether Germany's fiscal certainties are changing for good. Higher yields mean higher interest costs for the state, and if markets lose confidence, those costs can compound, turning a rescue into a long-term burden on public budgets. That is the precise danger Berlin must manage. Buy time for the economy to recover without spooking investors into demanding ever higher returns. So how is the package structured? At its heart are two pillars. The first is heavy investment in infrastructure: rail, freight, ports, broadband, and the rebuilding of critical logistics that connect factories to markets. The second is an aggressive pivot to domestic clean energy: offshore wind farms, large onshore projects, grid upgrades, and battery storage, all intended to replace expensive imported gas with homegrown electricity and, over time, to lower industrial energy costs. Together, the goals are productivity and energy security. Move goods faster, power them cheaper, and make German manufacturing competitive again. The economic playbook draws on old examples. Post-war Japan rebuilt, with massive public investment, and decades of growth followed. But Germany today is a different world. It is already highly developed. The low-hanging fruit of reconstruction is gone. Marginal returns on new highways, plants, or digital upgrades are smaller and slower to appear. That raises an uncomfortable question. Can public investment in an advanced economy produce enough short-term lift to calm markets and create a medium-term productivity boost? Or will the heavy upfront costs simply load the balance sheet without delivering the growth needed to amortize them? Politically, the gamble changes the compact between Berlin and Europe. Germany has for decades been the fiscal anchor of the Eurozone, the economy that others looked to in times of trouble. Lenders bought Italian, Greek or Spanish debt on the collective assumption that Germany would be the backstop in a crisis. If Germany weakens, that latent assurance phrase, contagion risk across the Eurozone rises. Yet the alternative, doing nothing, risks a slow erosion of Germany's industrial base and tax stake, which would be disastrous for Europe as well. So Berlin made a high-risk, high-reward choice, shoulder a large fiscal burden now, in the hope of stabilizing both itself and the monetary union. There are practical risks and fault lines. Large public investments require time-consuming planning, permits, skilled contractors, and efficient procurement. Delays blow out costs. Political fights dilute focus. There is the danger of misallocation, spending on projects that create short-term headline jobs but little long-term productivity. There is also the international dimension. If Germany successfully reboots, it may capture more market share, provoking trade friction. If it fails, a weakened Germany could pull Europe into a wider downturn. Then there is the fiscal arithmetic. Even with growth, the debt service bill will rise substantially in the near term, and interest rate moves by the ECB or markets can rapidly change the calculation. Yet there is an argument for urgency. Energy replacement projects, when built at scale, can lower industrial input costs and remove a key vulnerability that throttled production. Faster freight and digital connectivity can reduce supply chain friction that has been eating margins for years. And targeted support for energy-intensive industries can preserve the core exporters that pay the taxes and employ millions. In short, the package is not just Keynesian demand stimulus. It is a structural bet that addresses supply constraints that have become existential. The human cost is immediate. Unemployment has risen significantly. Factory towns feel fragile. Apprenticeships have become less certain, and political anxiety runs high. This is an industrial strategy with a social face. Protect jobs, maintain the skills base, and prevent long-term scarring that would make recovery harder and less inclusive. The political calculus is blunt. Failure risks electoral fallout at home and systemic damage abroad. Success could restore growth and cement Berlin's leadership in Europe. In the end, Germany's decision to risk its long-cherished fiscal orthodoxy is a story about choices under pressure. It is about a nation that built stability on rules, now choosing flexibility in the face of shocks. If it works, the investment will be remembered as a decisive turn that saved an economy and steadied a continent. If it fails, the fallout will be measured not just in GDP numbers, but in lost jobs, weaker public services, and a Europe more exposed to financial shocks than it has been in decades. The next few years will tell whether this is Germany's triumph or a cautionary tale about the limits of even the boldest state interventions in a highly integrated global economy. This was a gamble made in the shadow of idle factories and frozen furnaces, a decision to spend, to rebuild, and to try to buy time for an industrial nation. The question is not just whether Germany can pay the bill. The question is whether the bill will buy back what has been lost: work, power, and the quiet confidence of a people who long believed their economy was unbreakable. The answer will shape Europe for a generation.